You may think that variables like productivity and profitability are the major components that drive the stock market, but beyond the thousands of analysts working in investment banking crunching numbers and data, there is one variable that is the single most important component in our economy today. The effective federal funds rate, also known as the interest rate. This number set artificially by the United States Federal Reserve acts like gravity. Push the lever up, increase the rates, and all of a sudden bonds become very attractive while stocks falter and fade out. Now when you hear the word bond, you likely get very bored and look to find a new video, but bonds today have become incredibly important in determining the future of the market, one which is currently sitting on quicksand built on top of a house of cards. The way it can be described is simple. We know that the United States sells bonds, which are essentially risk-free investment in that unless the government defaults, they will pay you the coupon rate. The coupon or coupon payment is the annual interest paid on a bond expressed as a percentage of the face value and paid from the issue date until maturity. So just so you understand, you can currently buy a 30-year bond and it'll pay you 2.3% a year for 30 years. Now why am I telling you this? Well, think about what a stock is. A stock is the same thing except the coupon rate is unknown. It's up to the investor to figure out how much a stock or company will return over the long term. In recent times, the expected returns on stocks has hovered over 10%, meaning that almost nobody was buying bonds. But what happens when all of a sudden the government bond starts paying 10%? Well, it completely changes the value of this equity bond. Remember what I said earlier. When you buy Tesla, for example, you are essentially buying an equity bond with the hope that this company will return cash to you over time. The expected return is the coupon rate. That is the very basis of how stocks are valued. The higher the theoretical coupon rate, the higher the stock price. Now, when the government raises rates and bonds begin paying generously, well, now a company like Tesla has to compete with the bond market and it will ultimately lose value as money begins to pour from equities to bonds. For example, in 1982, the long-term US government bond got up to 15%, meaning that a company that had a 10% expected return was considered a subpar business, as you can just buy a bond and have those returns guaranteed. Meanwhile, that same company in a 3% long-term bond environment would be considered an excellent investment. And that example goes to show you that the entire investment environment can be shifted if the bond market begins to compete with the equity market. Recently, bonds have been dead and stocks have had excellent returns, thus bigger and bigger prices. Take one look at the S&P since the Fed lowered rates to zero and you'll see exactly what I mean. Even Warren Buffett agrees that bonds have been useless. Take a listen.
Taking a bond, if you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days it does now, it's electronic, but it has a whole bunch of coupons, and the coupon says 3% or whatever it may say, and you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet, and it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity. If they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
But the game is changing. Today we have record-breaking inflation, and in order to combat that, the Federal Reserve will look to raise rates. By doing so, the bond market becomes more and more attractive. We are already seeing 10-year bonds reaching the highest level since 2018. And of course, the market has been faltering during the same time. This also happened in 2018 when bonds were hitting that critical 3% mark. That year, the S&P was negative for the first time since 2009. The only difference today is that a certain portion of investors believe that the Federal Reserve is all talk. You see, once they raise rates past a certain point, things will break down in the equity markets, and faced with a recession, Powell will do what he hoped he would never have to do: lower rates back to zero, introduce more QE, and save the stock market while ignoring the rapid inflation. People like Peter Schiff often say that the Federal Reserve would rather live with high inflation than a deep recession, and in the coming year, we will find out who will be right. Despite recent jumps in prices, we have yet to see the all-out wage price spiral that dooms many economies. You may have noticed that your wage hasn't kept up with the massive price increases everywhere, including the grocery store and the gas station. According to many economists, wages are the last thing to move up in this cycle, and when they do, that's when we really see how bad things can get inflation-wise. Mohamed El-Arian appeared on CNBC to speak on exactly this. Take a listen to his analysis.
Paul Krugman was out yesterday and today making some comments about how he is less dovish than a lot of other economists out there. He said that we could actually see a drop in some of the inflation prices. Even tomorrow, you could see a drop off because of lower shipping prices and things. But he's worried that the job market is still far too tight. And so the Fed, he thinks, should not stop hiking rates, even if they see inflation numbers come down. Do you agree with him or not?
So I agree with him. In two things. One is we're going to see a rolling over of the drivers of inflation. And that started last year as the drivers broaden. And we're going to focus a lot more on the labor market and on wage increases because inflation expectations are on the move. I also think the Fed has no choice but to tighten monetary policy, both through QT and higher rates. The question that no one knows is, will the Fed restore its credibility?
Whatever you may believe, we know that the Fed is stuck between a rock and a hard place. The bond market is currently doing a lot of the work for them, but once they raise rates themselves, the true strength of this economy will be revealed. How far they can push rates without breaking something is the ultimate question, and once it does break, will they sacrifice the dollar over the stock market? Thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it.